We have officially crossed a red line that most investors never spot until it is already in the rear view. For years, this channel warned the silver market wasn't just undervalued, but structurally rigged. Suppression wasn't a theory, it was a mechanism. Prices were capped not by natural supply and demand, but by leveraged paper contracts and the gamble that nobody would stand for delivery all at once. And now that gamble has failed, what occurred is not a rally. It isn't excitement, it isn't optimism, it is a total system rupture. Silver did not move higher in an orderly fashion. It didn't climb, it detonated. A double-digit percentage move in a single session is not how healthy markets behave. Commodities do not explode 10% in one day under normal conditions. That sort of violent movement only happens when something snaps underneath the surface. When forced buyers replace willing buyers. When survival replaces strategy. When a broken system stops negotiating and starts liquidating. Somewhere, a massive short position reached its breaking point. Margin calls were issued, collateral failed, and the clearing process took over, turning risk management into a blind algorithm with one instruction: buy at any price immediately. In thin liquidity with no seller stepping in, price didn't travel, it teleported. That vertical line on the chart isn't bullish enthusiasm. It is the undeniable footprint of a complete failure. This is why this moment matters. Because once forced liquidation enters the market price, discovery changes forever. The old rules stop applying. Resistance levels become irrelevant. Analysts arguing about fair value are left behind. What remains is urgency, fear on one side, disbelief on the other, and a rapidly shrinking pool of physical metal in between. We are standing at the edge of a new phase, not just for silver, but for confidence in the paper system that priced it. This chapter is the opening signal, not the climax. And if you are watching this now, you are early to the realization, even if the price no longer feels early. The event horizon has been crossed. There is absolutely no rewind button. If this analysis resonates with you, press 1 in the comments to confirm you are still with me and subscribe so you don't miss what comes next. This story is just beginning. To understand why this move was so violent, you have to understand what forced buying actually looks like inside the machinery of the financial system. In a normal market, price is discovered through negotiation. Buyers wait. Sellers hesitate. Liquidity forms a bridge between opinions, but in a liquidation event, that bridge collapses. The market stops being a conversation and becomes a crowded emergency exit. When a leverage fund fails, control is taken away from human decision-makers. The clearing system steps in and executes without judgment, without patience, and without regard for price. The objective is not profit. It is containment. Positions must be closed immediately to prevent losses from spreading further. This is where price loses its meaning and pure speed replaces logic. What we saw was the order book being consumed in real time. Every sell order was lifted not because someone believed silver was cheap, but because someone had no choice. Volume surged not as confirmation of optimism, but as evidence of stress. This is the signature of a short squeeze moving from theoretical to systemic. Retail shorts go first, then family offices, and eventually institutional funds with balance sheets large enough to distort markets when they collapse. This is the moment where dominoes stop falling one by one and start collapsing in clusters. Because large shorts are not isolated bets. They are embedded in portfolios, hedged against other positions, and intertwined with credit lines. When one leg breaks, the strain transfers across the entire structure. That is why a 10% move in silver is not about silver. It is about the stability of the rigged framework that allowed that position to exist in the first place. At this stage, sellers disappear. Not because they want higher prices, but because they don't trust settlement. When counterparty risk enters the equation, paper claims lose credibility. The fear is no longer missing upside. The fear is not getting paid, and once that fear spreads, liquidity vanishes faster than any trading algorithm can replace it. This is how localized stress becomes systemic pressure, not through headlines, but through margin calls, collateral gaps, and forced execution. The market is no longer pricing value. It is pricing survival. And that shift is irreversible once it truly begins. Now we need to zoom out, because silver never moves alone. It has a shadow, and that shadow is gold. Gold is the anchor of the precious metals complex, the signal that tells you whether a move is speculative noise or a structural reset. And right now, gold is not whispering. It is confirming loudly. Gold holding extreme levels is not a coincidence. Historically, gold leads, silver follows, and then silver accelerates. When gold establishes a new plateau, it gives algorithms and institutions a reference point. They don't ask whether silver should move. They ask how far behind it is. That gap is exactly where the chase begins. The gold-to-silver ratio is one of the oldest valuation tools in the market. When fear rises and currencies weaken, that ratio compresses. Capital rotates from the larger, more stable metal into the smaller, tighter one with higher beta. That rotation is mechanical, not emotional. Models trigger, funds rebalance. Momentum strategies activate. Silver becomes the expression of the same macro stress fully amplified. This is why vertical charts feel unnatural. For years, silver was conditioned to move slowly, capped by paper supply and controlled volatility. That conditioning trained investors to distrust sharp advances. But once gold validates the move, that conditioning breaks. The suppression phase ends, and the catch-up phase finally begins. This catch-up is powerful because it is fueled by math, not opinion. If gold reprices, first silver must follow to restore balance, and the longer silver lags, the more aggressive the eventual move becomes. That is what we are seeing now. Not exuberance, but compression, releasing violently. What makes this moment dangerous for skeptics is that silver still appears cheap relative to gold even after a historic day. That perception invites capital at the worst possible time for those betting against it. It pulls in algorithms designed to exploit ratio dislocations and forces late shorts into impossible trading decisions. This is the transition point. From disbelief to recognition, from denial to momentum, gold has spoken and silver is responding, not politely, not gradually, but all at once, right now. While price action is unfolding on the screen, the real stress is building where most investors never look, the physical market. This is where paper narratives collapse because metal cannot be printed, rehypothecated, or delayed without consequence. When price moves faster than logistics, the illusion of abundance totally disappears. As silver surged, physical dealers didn't raise prices. Many simply stopped selling. Sold-out site maintenance call for pricing. These are not marketing tactics. They are warning signals. When volatility exceeds software limits, dealers step back because quoting a price becomes a liability. If metal gaps higher overnight, every posted price becomes a serious loss. This is how a paper spike transforms into a physical shortage. The screen price freezes while the street price runs. Coins bars and industrial supply begin trading at levels disconnected from official quotes. At that point, spot price becomes purely theoretical. What matters is availability. Can you get the metal at all? And if so, how much are you willing to pay? This is the definition of a currency crisis. When goods cannot be purchased at the official price, the currency used to price them is no longer trusted. People don't ask what silver costs, they ask whether it exists. And that question alone shifts behavior across the entire system completely. Industrial buyers feel this first. They don't speculate, they consume. When supply becomes uncertain, cost becomes secondary. Contracts include force majeure clauses, and in extreme volatility, those clauses get activated. Deliveries are delayed, shipments are renegotiated. Manufacturers are forced into the open market to compete with investors for the exact same ounces. This is where panic buying begins, not driven by greed but by necessity. When industry enters the spot market, it removes supply permanently. That silver doesn't return to vaults. It becomes product infrastructure technology. Once consumed, it is gone forever. This is why vertical price moves don't resolve quickly. The metal is leaving the system while demand accelerates, and no chart can model that scenario in advance. Now we need to talk about what happens when this kind of stress collides with the rules of the exchange itself. Futures markets are built on the assumption of orderly movement. To protect the system, exchanges install circuit breakers, daily price limits designed to slow things down when volatility becomes extreme. But these safeguards are not solutions. They are pressure valves. And when pressure keeps building, freezing, the market doesn't remove risk. It concentrates it further. With silver already sitting near historic thresholds, even a modest gap higher at the open is enough to trigger a limit event. When that happens, trading halts. No buying, no selling, just a frozen screen. For long-term holders, this feels validating. For anyone short, it is pure terror. Losses continue to grow, but there is no exit. Time becomes the absolute enemy. Panic stacks up just like silver. Halts don't chill the players, they cage them. The shorts know when the bell rings, spot rips higher. That fear forces them to cue massive buy orders for the open at any price. Those panic bids spark the exact explosion they dread. It's a death spiral for paper shorts, and once it ignites, it consumes everything in its pure path. We have seen this play out in smaller arenas: nickel, lumber, energy. Every time the outcome was identical, liquidity dried up, faith died, and true price discovery returned at levels nobody projected. The silver market is bigger, more vital, and more politically charged than any of those. That means the fallout is going to be magnified. This isn't a game for leverage. Volatility this high wrecks margin accounts even if the stacker is directionally right. A $5 rip becomes routine. A $10 smash becomes possible. Survival favors those who hold physical metal without debt and can sit tight. The COMEX can slow the tape, but it can't print silver. As long as hunger exceeds the physical supply, every halt just delays the inevitable moonshot. The paper machinery is straining, and limits aren't a ceiling anymore. They are a loud signal that the riggers are losing all control. Now focus shifts from retail to institutions, because big money moves markets when forced to react, not when they plan to. For months, funds expected to stack silver later. They penciled allocations for the new year. They assumed time was on their side. That weak assumption has just totally collapsed. Institutional cash isn't patient money. It is benchmarked, ranked, and always compared. When the shiny moves 10% in one day, it stops being ignored and starts being chased. Performance pressure kicks in. Funds underweight on silver suddenly face career risks. Not stacking it becomes more dangerous than buying it at the top. This is why sharp rips attract fiat instead of repelling it. A violent breakout signals gains to momentum strategies. The algos don't ask if the price is high. They ask if it is accelerating fast. And acceleration is exactly what a forced short liquidation event produces. As these funds step in, they don't buy crumbs. They buy massive bars regardless of the volatility. Their entry squeezes supply further because they aren't trading paper in and out. They are reallocating wealth. Once that money enters, it stays put until a new market equilibrium forms. But this is where turbulence jumps. Early stackers see gains that feel unreal, profit-taking hits. Tamps become sharp. A $5 drop feels fatal to someone who just arrived, even though it is nothing in a vertical market. This is where weak hands exit and the strong diamond hands absorb. The key distinction is trend versus noise. In a repricing, corrections aren't reversals, they're pressure releases. Each dip transfers shiny from impatient holders to stackers with longer time horizons. That process strengthens the trend rather than weakening it at all. This is why discipline counts now more than ever. Emotions are expensive, hubris is punished, fear is punished faster. The market isn't forgiving because it isn't balanced, it is fully transitioning. The institutions are waking up, and when they move, they don't tiptoe. They reshape the entire financial landscape. When markets move this violently without a clear headline, it means the news hasn't reached the sheep yet. Price moves first. Intel follows. This is one of the oldest rules in rigged markets, and it is especially true in commodities tied to geopolitics, industry, and global sovereign interest. A sudden 10% move is the market screaming that something is breaking behind the scenes. It could be stress inside a financial house. It could be a settlement failure. It could be an interruption in supply that hasn't been formally announced. Whatever the cause, someone with better info is acting, and they are acting with real urgency. This creates information asymmetry. Insiders position quietly while the public debates narratives. By the time confirmation arrives in the news cycle, the price is already adjusted. That is why waiting for certainty is so costly. Certainty always comes at a significantly higher premium. At this stage, rumor itself becomes fuel. Whispers about counterparty failures, vault delivery delays, or emergency meetings don't need to be proven to affect behavior. They change incentives. Sellers hesitate. Buyers accelerate. Trust erodes. In markets built on confidence, the deep erosion is really enough. This is also where global dynamics matter. Silver is not priced by one country. When stress appears in one region, capital shifts through time zones. Asia reacts to New York. Europe reacts to Asia. Each session inherits the anxiety of the previous one and adds its own urgency. Price gaps replace intraday movement. The market simply no longer sleeps. This is how localized disruption becomes global repricing. Not through a single event, but through cascading reactions across regions that no longer trust the same assumptions. And once that cascade begins, there is no central authority capable of reversing it fast enough now. The market is telling us that something significant is unfolding. The price is the true message. Everything else is noise. As the system reacts, industry does not wait for explanations. It acts. This is where silver's role becomes impossible to ignore because unlike stocks, silver is not optional. It is embedded in production. Energy, electronics, defense, medical tech. When availability is questioned, procurement behavior changes instantly. Industrial buyers are not speculators. They don't debate charts or ratios. They manage continuity. A factory that cannot secure inputs does not slow down gracefully. It stops cold. That risk is existential. So when price volatility signals potential shortages, cost becomes secondary to certainty. Paying more is preferable to not receiving metal at all. This is how off-market deals emerge. Long-term contracts are renegotiated. Suppliers invoke force majeure. Buyers bypass public exchanges and strike private deals directly with miners. Metal that once flowed into transparent markets disappears into closed supply chains. From that moment on, it is no longer part of available inventory. It is spoken for. This privatization of supply is invisible on price charts until it suddenly isn't. Official production numbers may look stable, but deliverable supply collapses. Vault inventories drain down. ETFs struggle to source real metal. Futures contracts settle in cash instead of ounces. Confidence in paper exposure erodes further. At the same time, the public begins to wake up. Not cause of fundamentals, but cause of movement. Sharp price action captures attention in a way years of DD never could. Searches spike. Retail orders queue up while markets are closed. Demand stacks quietly waiting for the next market open. This is where scarcity accelerates. Industrial demand removes supply permanently. Retail demand removes liquidity unpredictably. Institutional demand removes flexibility. And none of them coordinate. They simply react to the exact same signal. The system was built to handle one of these forces at a time, not all of them together. That is why stress multiplies instead of dissipating. The metal is being pulled from every direction and nothing replaces it fast enough. When pressure builds across financial, industrial, and retail channels simultaneously, the weakest link is always the intermediary. Futures markets are zero-sum systems. For every winner, there is a loser. And when price moves violently, those losses do not stay contained. They accumulate. The scale of this move tells us the losing side isn't retail. Small traders can't absorb multi-dollar swings. They are eliminated early. To withstand this kind of damage and still function requires balance sheets measured in billions. That points directly to the systemically important institutions. The same entities responsible for providing liquidity are the ones now under strain. When a clearing member fails to meet a margin call, the exchange steps in. It seizes collateral, liquidates positions, and attempts to contain the damage. But containment has its limits. If losses exceed posted collateral, the exchange draws from its default fund, a pool financed by other members. Losses spread laterally. This is contagion. One failure weakens others. Liquidity is withdrawn. Trust erodes. Banks begin to question each other's exposure. Lending tightens. Stress leaks into unrelated markets, bonds, funding rates, credit spreads. What began as a metals trade becomes a massive balance sheet problem. This is why central banks eventually appear, not to save silver traders, but to stabilize the plumbing of the system. And stabilization always requires liquidity. New liquidity dilutes currency. Diluted currency pushes hard assets higher. It is a self-reinforcing debt trap. Attempts to suppress price to protect institutions backfire because they signal weakness. Every intervention confirms scarcity. Every reassurance accelerates demand. Confidence cannot be restored by decree once it is cracked open. This is the stage where markets stop reacting to policy and start forcing it. The metal is no longer a trade, it is a verdict on fiat trust. This is where strategy replaces emotion. In a vertical repricing phase, the real risk is not volatility but poor decisions made under pressure. The goal is no longer to chase price but to understand the cycle and act with pure discipline. Silver's breakout isn't a gamble. It is a flight from dying fiat to hard money swapping empty promises for heavy metal. This reset hits in waves, denial mania, then acceptance. Most fail not on the thesis but by reacting without a concrete trading plan. Possession beats timing the bottom. Leverage